A gas station attendant in Vermont dies at 92,
Yeah.
and the will says $8 million. Same year, a Harvard-trained Merrill Lynch exec is losing his mansion to foreclosure. Nobody's IQ explains that.
Well, right. I mean, the disconnect there is just massive.
Yeah.
Because we're so conditioned to evaluate financial success the exact same way we evaluate, like, engineering or medicine.
Yeah, as a hard science.
Exactly. We treat it as this strict environment where inputs predictably equal outputs. You would never expect a janitor to step into an operating room and just casually perform a flawless triple bypass.
No, of course not.
Right, because medicine is bound by objective knowledge, but finance is fundamentally different. It's overwhelmingly a soft skill. And what we're really unpacking today, diving into Morgan Housel's The Psychology of Money, is the reality that doing well with capital has almost nothing to do with your baseline intelligence.
And absolutely everything to do with your behavior.
Yes.
Okay, let's unpack this right now, because the mission for this deep dive is to basically rewire how you, the listener, look at every single dollar in your bank account.
Which is a big promise, but I think we can get there.
Oh, we're definitely getting there. We're dissecting the behavioral architecture of wealth today. We want to figure out why brilliant people routinely blow up their portfolios and why utterly ordinary people like that gas station attendant build generational wealth.
And to really do that, we have to drop into the specific, localized realities of those two lives you just mentioned in the cold open.
Yeah, let's look at Ronald Reed. So this guy was born in rural Vermont, hitchhiked to high school, and spent 25 years fixing cars at a gas station.
Just a completely normal blue-collar life.
Totally. Then he spends another 17 years sweeping floors at JCPenney. He bought this little two-bedroom house for $12,000, lived there his entire life, and his main hobby was just chopping firewood.
Chopping firewood for fun.
Right. But when he died in 2014, he left $2 million to his stepkids and more than $6 million to his local hospital and library.
And the mechanics of how Reed actually achieved that are like mundane to the point of being totally invisible.
What do you mean by invisible?
Well, he simply bought blue chip stocks and just held them for decades. That's it. He didn't use leverage. He wasn't trading options. He didn't panic sell during Black Monday in '87 or the 2008 crash.
He just sat there.
He just sat there and let compounding operate quietly in the background. But then you compare that baseline psychological fortitude to Richard Fuscone.
Oh, man. Fuscone, the exact opposite end of the spectrum.
Literally the opposite. Harvard MBA, wildly successful executive at Merrill Lynch. The guy was so successful, he retired in his 40s to become a philanthropist.
He was on those under 40 lists, right?
Yeah, high-profile guy. And his sensory reality was this 18,000 square foot mansion in Greenwich, Connecticut. It had 11 bathrooms, 2 elevators, 7 garages.
Wait, didn't it have an indoor pool, too?
It did. An indoor swimming pool covered by a see-through dance floor.
See, that is just wild. But wait, Fuscone had access to the highest tier financial data in the world. He was literally inside the machine at Merrill Lynch.
Exactly. She wasn't some amateur.
Right. He understood macro indicators, liquidity, debt-to-equity ratios. So how does a guy with that much structural advantage end up standing in front of a bankruptcy judge in 2014, declaring he has basically no income, while his mansion with the see-through dance floor gets foreclosed and sold for pennies?
It's crazy to think about.
I refuse to believe it's purely a matter of he got greedy. There has to be a deeper systemic miscalculation there.
Well, there absolutely is. The miscalculation is the assumption that financial data somehow overrides the human ego. Fuscone expanded his lifestyle using extreme leverage. So when the 2008 crisis hit, illiquidity didn't care about his Harvard MBA. A margin call is mathematically ruthless.
Because the bank just wants its money.
Right. If you borrow heavily against your assets to fund this massive high burn rate lifestyle and the value of those collateral assets suddenly drops, the bank demands cash immediately.
So he was forced into a corner.
He was forced to liquidate at the exact worst possible moment. Whereas Reed, holding no debt and requiring very little cash to just live and chop his firewood, he had infinite optionality. He was never forced to sell.
Wow.
The thesis here is that behavior simply cannot be taught or modeled in a spreadsheet. A genius who loses control of their emotions or allows their ego to dictate their leverage will become a financial disaster.
So to win this game, being reasonable beats being mathematically rational.
Every single time. We are conditioned by society to think of wealth as loud and visible, right? The mansions, the sports cars, the dance floors. But the core truth here is that wealth is what you don't see.
Okay, I love that. But let me push back on this idea that behavior is everything for just a second. Because uh, honestly, that can feel slightly like a self-help platitude if we don't define where that behavior actually comes from.
Fair point.
If a listener is sitting there thinking, okay, cool, I just need to act like Ronald Reed and not like Richard Fuscone, that kind of ignores the neurological reality that we are totally programmed by our environment.
Right, it's complete.
Like, people do wild, seemingly irrational things with their portfolios all the time. They buy meme stocks at the peak. They hoard cash during a massive 10-year bull run.
Well, the foundational premise to understand here is that no one is actually crazy.
Nobody.
Nobody. Every single financial choice a person makes, no matter how disastrous it looks in hindsight, makes perfect rational sense to them in the exact moment they execute the trade.
Okay, walk me through that. Why does it make sense to them?
Because we are all heavily anchored to the distinct economic realities of our formative years. I mean, your personal lived experience with money makes up maybe like 0.000000001% of what's actually happened in global economic history.
Which is basically nothing.
Right, essentially nothing. But it dictates about 80% of how you construct your internal model of how the world works.
It's entirely autobiographical.
Yes, exactly.
To make this really concrete, picture this. Drop yourself into 1960. John F. Kennedy is running for president, and he's being interviewed by a reporter who asks him what he remembers about the Great Depression. Now, this was the defining economic trauma of the 20th century. It permanently scarred the psychology of millions of Americans.
The defining event of a generation.
Right. And JFK, with total candor, just admits he had zero firsthand knowledge of it.
Zero.
Zero. His family possessed one of the great fortunes of the world. So while banks were failing and bread lines were stretching around the block in cities across the country, the Kennedys were literally just acquiring bigger houses and hiring more servants.
Wow. Talk about a bubble.
It's crazy. The only direct exposure JFK had to the Depression was seeing his father hire extra gardeners, purely to give local men a way to feed their families. He literally stated on the record that he only learned about the Great Depression by reading about it in textbooks at Harvard.
And see, JFK's admission there isn't an indictment of his character. It's a perfect illustration of localized reality. Think about the stockbroker who watched his entire net worth evaporate in 1929. The guy who experienced the visceral, physical terror of sudden poverty. He developed a physiological fear of equities.
A fear in his bones.
Yes. He experienced a reality that, say, a tech worker basking in the glory of the late 1990s dot-com bubble simply lacks the neurological hardware to even imagine.
But surely a financially literate audience like the people listening to this deep dives right now can override this with backtesting and historical data, right? I mean, math is math.
You would think so.
I can pull up a chart of the S&P 500 dating back to 1926. I can run Monte Carlo simulations all day. If I can intellectually observe that markets generally recover, what? Does my personal childhood experience or the macro environment of my 20s still hijack the steering wheel when I'm like 50?
Because backtesting a portfolio on a computer screen does not simulate the cortisol spike in your bloodstream when you have to look your spouse in the eye and explain that your child's college fund just dropped by 40%.
Oof. Yeah, that's real.
Spreadsheets lack an endocrine system. And to put actual empirical weight behind this, look at the 2006 study published by the National Bureau of Economic Research. It was authored by Ulrich Malmendier and Stefan Nagel.
And they didn't just theorize about this, right?
No, they didn't. They mined 50 years of empirical data from the Survey of Consumer Finances.
They basically tracked exactly how people allocated their capital over half a century.
Exactly. And what the data revealed is that an investor's willingness to take financial risks depends almost entirely on the macroeconomic history of their specific youth.
Not their intelligence.
Not their intelligence, not their access to data. If you grew up in the 1970s, your formative economic years were defined by rampant stagflation. Prices were skyrocketing, purchasing power was just eroding every single day.
Gas lines, all of that.
Right. So you learned viscerally to view bonds, which textbooks will confidently tell you are a safe asset class, as absolute wealth incinerators, because inflation was eating the fixed yield alive.
But then take someone like Bill Gross, the legendary bond manager.
Precisely. Bill Gross's entire professional career perfectly coincided with a generational, decades-long collapse in interest rates.
And when interest rates fall, bond prices rise.
Exactly. Gross experienced an environment where bonds were these phenomenal wealth-generating machines. So you have the exact same financial instrument, a bond viewed through completely opposite lenses.
And both views are totally rational based on the localized world that raised the investor.
Totally rational.
So, if you're listening to this right now and feeling frustrated because you tend to hold way too much cash, or you're terrified of a market correction, you really have to look at the era that formed you.
You really do.
But wait, if when and where you were born dictates your baseline risk tolerance, we kind of have to confront something that deeply offends the American ethos of meritocracy.
Oh, this is the uncomfortable part.
Right, because if your financial behavior is programmed by the era of your birth, then we are dealing with the ultimate invisible force.
The random roll of the dice. We have to talk about luck and risk. We classify them as different concepts usually, but they are siblings. They are the exact same force variance from the mean, simply operating in opposite directions.
Same exact force.
Yes. Every outcome in life is guided by systemic forces external to individual effort. That makes it incredibly dangerous to judge financial success, whether it's your own or someone else's, purely as a derivative of skill.
Now, this is where I know some listeners are going to start to bristle, because telling people that luck plays a massive role in their portfolio, it kind of breeds financial nihilism.
Right. They think, what's the point?
Yeah, if it's all just a coin flip, why should anyone bother analyzing a balance sheet? Why not just throw darts at a board?
Well, acknowledging luck isn't an invitation to nihilism. It is a requirement for accurate risk assessment. You still have to play the game to expose yourself to the positive variance, but you have to recognize the structural advantages when they're there.
Okay, give me an example.
Let's examine one of the most mythologized success stories in modern history. The year is 1968. Out of roughly 303 million high school-age individuals globally, about 18 million live in the United States.
Okay, narrowing it down.
Right, narrowed it down further. Roughly 270,000 live in Washington state, just over 100,000 in the Seattle area, and only about 300 of those students attend Lakeside School.
And Lakeside is the anomaly here.
It is a profound statistical anomaly. Those 300 kids were at one of the only high schools on the entire planet that had the foresight and, critically, the Mothers Club funding to lease an ASR-33 teletype terminal connected to a GE mainframe.
Wait, in 1968?
In 1968, most university computer science departments didn't have that level of access yet. Computing time back then cost the equivalent of hundreds of dollars an hour.
And Bill Gates just happened to be one of those 300 kids.
Yes. Now, was he brilliant? Yes. Was he relentlessly driven? Yes. But he also received a 1 in a million head start. Gates himself has explicitly stated on the record that if there had been no Lakeside, there would have been no Microsoft.
So he had the skill,
Yeah.
but he was injected into an environment that perfectly catalyzed that skill.
Exactly.
But the reason we're bringing this up isn't to diminish Bill Gates, right?
No, not at all.
It's to highlight the other side of that exact same coin, the risk sibling. Because there was a third kid in that inner circle alongside Gates and Paul Allen, a kid named Kent Evans.
Yeah. Kent Evans is the embodiment of the risk sibling.
By Gates' own account, Kent was arguably the smartest student in the class. They shared the exact same business acumen. Gates actually recalls Kent carrying this large lawyer's briefcase around the middle school hallways.
In middle school?
In middle school. They were designing schedule-making software together. They were scheming about being CEOs. Right. Gates, to this day, still remembers Kent's childhood phone number 525-7851.
That's how close they were.
They were on the exact same trajectory, possessing the exact same skill set.
But Kent Evans never graduated high school.
No.
He died in a mountaineering accident. And the statistical probability of dying on a mountain in high school is roughly 1 in a million. Bill Gates experienced 1 in a million positive variance luck. Kent Evans experienced 1 in a million negative variance risk. It is the exact same force, same magnitude, just pushing in opposite directions.
Kent Evans was just as skilled and just as driven, but he encountered an absorbing barrier. He ended up on the wrong side of life's roulette wheel, where the game simply stops.
And that concept of an absorbing barrier is absolutely critical here. In systems where a single bad event can completely remove you from the game, whether that's a mountaineering accident or a massive margin call standard expected value mathematics, just fail.
So if luck gets you access to the Lakeside computer, what actually builds the lasting fortune over time?
Yeah.
Because it's not just a lucky break where you suddenly materialize as a billionaire overnight.
Hmm.
There's a quiet mechanical process that takes over, right?
Yes. And it's important to realize that tremendous force is rarely required for tremendous results. The fundamental mechanism of wealth generation is time. It is the confounding, highly unintuitive nature of compounding.
Unintuitive is the perfect word for it.
Because the human brain is linear. We expect a unit of input to yield a unit of output. But compounding is exponential, which makes it feel almost invisible until the very end of the curve.
It's the quiet giant.
Exactly. Think about the astrophysics and geology of an ice age for a sec.
Okay, taking a pivot to geology, I like it.
Bear with me. We have this Hollywood image of an ice age, starting with this sudden apocalyptic winter that just freezes the globe in a month. But the actual mechanism, which is driven by Milankovitch cycles, these slight changes in the Earth's orbital eccentricity and axial tilt, it actually starts with a moderately cool summer.
Wait, not a brutal winter, a cool summer.
Exactly, one cool summer. A summer where the temperature just doesn't get quite warm enough to melt all the snow from the previous winter. So you are left with this tiny, persistent base of ice.
Okay.
That residual ice increases the Earth's albedo, meaning it reflects more solar radiation back into space.
Because it's white and reflective.
Right. And because less heat is absorbed, the following winter is marginally colder, which means more snow falls. Then the next summer, an even larger base of ice survives, reflecting even more sunlight. This fractional incremental change compounds upon itself until you literally have continental ice sheets miles thick.
That is insane.
It is not the severity of the initial snow. It is the duration of the persistence.
That is the perfect mental model for Warren Buffett.
It really is.
When Housel published this book, Buffett's net worth was roughly $84.5 billion. But here is the statistical reality that completely breaks your brain when you hear it. $81.5 billion of that wealth was generated after his 65th birthday.
Over 96% of his total net worth materialized after standard retirement age. Let that sink in.
It's unbelievable. So if we strip away the mythology and just run the formula for compound interest, right?
Yeah.
Future value equals present value times 1 plus the rate of return to the power of time.
The standard formula.
Imagine if Buffett had lived a normal life. Say he spent his 20s exploring the world, finally sat down at age 30 to invest with a starting bankroll of $25,000, and then decided to retire at age 60 to just, I don't know, play golf.
Like a lot of people do.
Exactly. Even if we grant him his phenomenal, world-beating 22% annualized returns for those 30 years, his net worth wouldn't be $84.5 billion. It would be $11.9 million.
Which is 99.9% less than his actual net worth.
The narrative we always tell about Buffett is that he is the greatest stock picker of all time. But the math tells a totally different story. His actual secret isn't his 22% return.
No, it's the exponent in the formula.
It's the time. It is 80 unbroken years of runway because he started allocating capital when he was 10 years old.
And if you want to prove that the duration matters more than the rate of return, just look at quantitative finance. Look at Jim Simons and Renaissance Technologies.
And Medallion Fund.
Yes. Their Medallion Fund uses hidden Markov models and high-frequency statistical arbitrage. Simons has compounded money at an absurd, unprecedented 66% annually since 1988. 66%, that's 3 times Buffett's rate of return. It completely defies the efficient market hypothesis, yet Jim Simons' personal net worth is a fraction of Warren Buffett's, roughly 75% less.
Okay, but if he is tripling Buffett's returns every single year, how is it mathematically possible that he is that much less wealthy?
Because Jim Simons didn't launch his quantitative strategy until he was 50 years old. He simply lacked the decades of moderately cool summers. He didn't have the time for the ice sheet to build.
Wow.
If Jim Simons had achieved a 66% annualized return for the 80 years Buffett has been investing, his resulting net worth would be so cosmically large it would exceed the total value of the global economy.
That is terrifying and amazing.
The magic is entirely in the longevity.
But this introduces a massive psychological friction point, right? To let compounding operate for 80 years, you cannot interrupt it. You have to survive. Which means getting wealthy and staying wealthy are two entirely distinct and often totally contradictory psychological profiles.
Yes. Getting wealthy demands risk-taking, boundless optimism, and a willingness to step out on the bleeding edge. Staying wealthy demands the exact opposite.
What does it take?
It requires profound frugality, a defensive posture, and a very healthy dose of paranoia. Survival in a non-ergodic environment is the absolute cornerstone of wealth.
Let's look at the ultimate historical case study for this, Jesse Livermore.
Perfect example.
During the Roaring Twenties, he was arguably the greatest single stock market operator alive. He didn't just participate in the market, he moved it.
It was a whale.
Massive whale. By his early 30s, he had amassed an inflation-adjusted fortune of over $100 million. And then we hit October 1929, the Great Crash. The Dow Jones loses massive chunks of its value in days, suicides in the financial district, total macroeconomic devastation.
The worst of the worst.
But Livermore had anticipated it. He heavily shorted the market using the bucket shops and brokerage houses of the era. He was borrowing shares, selling them high, and buying them back at pennies. He made an absolute fortune while the rest of the country was economically eviscerated.
Right, because he was a master of the mechanics of getting wealthy. He understood leverage and momentum better than anyone else alive.
But he entirely lacked the survival mechanics. Making that much money during a global panic reinforced a deeply dangerous psychological bias. He felt omnipotent.
He thought he was invincible.
Yeah, he couldn't transition from the aggressive posture of acquiring wealth to the defensive posture of preserving it. He continued to employ massive, highly leveraged positions in an increasingly volatile market, attempting to replicate the dopamine hit of that 1929 short.
And how did that work out for him?
By 1934, he had completely blown up his portfolio. He lost everything and filed for bankruptcy. He didn't know how to stay wealthy.
Because compounding only works if you give an asset uninterrupted years to grow. If you take wild risks that periodically wipe you out to zero, the mathematical clock just resets.
You lose all your ice.
Exactly. The ice melts completely. Wealth, at its foundational level, is optionality. It is the structural advantage of never being forced to liquidate an asset during a market panic.
The optionality to simply sit on your hands and do nothing. Think about the listener right now who checks their portfolio every time the Federal Reserve makes a rate announcement.
Oh, everyone does it.
There is an overwhelming urge to act. But let's run a thought experiment covering the period from 1900 to 2019. Over that century plus, the U.S. economy spent roughly 300 months in a state of official recession.
300 months.
That is decades of cumulative panic, world wars, the Great Depression, stagflation, the dot-com bust, the 2008 meltdown.
A relentless sequence of macroeconomic terrors where the rational instinct is to flee to safety.
Exactly. So imagine three investors in this timeline: Jim, Tom, and Sue. Jim is highly reactive. Whenever a recession hits, he liquidates his equities and hides in cash to preserve capital.
Makes sense on a biological level.
Sure. Then Tom tries to employ a timing strategy. He waits for the recession to officially end, waits a few months for market confidence to return, and then buys back in.
Okay, a little more sophisticated.
And then there is Sue. Sue operates with complete indifference to the macroeconomic news cycle. She utilizes a strict dollar-cost averaging strategy, investing $1 every single month relentlessly through boom markets and global depressions.
She ignores the noise and focuses solely on the endurance of the compounding process.
The final results are staggering. Jim, the reactive cash hoarder, ends up with about $257,000. Tom, the market timer, gets about $234,000. Sue ends up with $435,551 others.
The double.
She radically outperforms them simply because she endured the market drawdowns without interrupting her compounding trajectory. She survived the moments of sheer terror by staying in her seat.
Survival is what allows you to endure the inevitable string of failures, and you absolutely will fail.
Oh, constantly.
Whether you are picking individual stocks, running a business, or managing a career, failure is the most common outcome. And this is critical to understand because in complex systems like the global economy, tails drive everything.
Tails. We're talking about the far end of a distribution curve, right? The extreme outlier events.
Yes, fat-tailed distributions in non-ergodic systems. In finance, a minuscule handful of extreme outlier events account for the overwhelming majority of all gains.
Right.
People operate under the delusion that to be a successful investor or entrepreneur, you must possess a high batting average. Like, you have to be right most of the time. The mathematical reality is that you can be wrong more than half the time, suffer dozens of small losses, and still win spectacularly big if you capture a tail event.
The Chris Rock analogy perfectly illustrates this dynamic outside of finance. When a listener boots up Netflix and watches a Chris Rock comedy special, what are they actually observing?
They're watching a comedic masterclass.
Exactly. The timing is flawless, every single punchline lands, the transitions are seamless. It looks like pure, unadulterated, effortless genius.
But that Netflix special is an illusion. It is a highly curated end product.
Right. What the audience doesn't see are the dozens of grim, unglamorous small comedy clubs in New Brunswick where he showed up unannounced on a Tuesday night for a year prior.
Just testing things out.
He is standing on stage, looking at crumpled notebook paper, fumbling his delivery and bombing terribly. He is beta testing hundreds of individual jokes, and the vast majority of them, the normal distribution of his ideas, fail completely.
Right.
The Netflix special is just the tail. It is the 5% of material that survived the brutal evolutionary process of those small clubs. The tail entirely masked the mountain of failures.
And that evolutionary model of testing and failing is exactly how the most dominant corporations on Earth generate capital. Look at Amazon.
Great example.
We view Amazon as this monolithic, unstoppable success. But Amazon has launched and funded spectacular, highly public failures. The Fire Phone was a massive capital bonfire. They lost staggering amounts of money developing it.
I totally forgot about the Fire Phone.
Because it doesn't matter. In a system driven by tail events, the Fire Phone failure is completely irrelevant. Why? Because it is offset by a tail event like Amazon Web Services. AWS generates tens of billions of dollars in operating income. They tested 100 ideas, failed on the hardware, and won a monopoly on the cloud. The single tail event drove the entirety of the company's valuation.
And Warren Buffett operates on the exact same power law dynamics. We think of him as having a golden touch. But at a Berkshire Hathaway shareholder meeting, he explicitly admitted that over his career, he's owned between 400 and 500 different stocks.
400 to 500 stocks.
And he made the vast majority of his generational wealth on roughly 10 of them.
Just 10.
Charlie Munger, his longtime partner, was even more blunt about it. He stated that if you simply remove a handful of Berkshire's top-performing investments from their history, their long-term track record becomes a complete joke. It reverts to average at best.
But this dynamic creates a very specific behavioral trap.
How so?
Well, think about it. If you endure the failures, if you let the compounding work, and you finally hit that tail event that generates significant capital, the biological human impulse is to signal that victory to the tribe. You want to display the wealth?
Oh, of course. You want the Architectural Digest house, the bespoke suits, the screaming Italian sports car.
Naturally. But engaging in that signaling triggers a severe psychological blind spot known as the man-in-the-car paradox.
Okay, if you are listening to this on your commute right now, I want you to picture this exact scenario. You are sitting at a red light, and a pristine, roaring red Ferrari pulls up next to you. It is a masterpiece of engineering.
Beautiful car.
Now, interrogate your own internal monologue for a second. When you look at that car, do you ever look at the driver and think, wow, the person behind the wheel of that Ferrari is a deeply impressive human being. I admire them.
Never. You almost never even register the driver's face.
You bypass the owner entirely. The thought process is immediately selfish. What you actually think is, if I were sitting in the driver's seat of that Ferrari, everyone on the street would think I'm incredibly cool.
That is the paradox in its purest form. We acquire visible wealth to signal to the world that we are worthy of admiration and respect. But the observers don't direct that admiration toward you. They simply use your expensive possessions as a prop in their own internal fantasy, projecting themselves into your position, assuming the wealth would bring them the respect they crave.
It's a localized illusion. Nobody on earth admires your possessions as much as you do. You drop a huge sum on a luxury watch thinking it purchases status, but humility, kindness, and empathy will yield a far higher return on respect than horsepower or Swiss movements ever will.
Which brings us to the operational definition of the entire concept. If you spend $300,000 on a Ferrari, you no longer have $300,000.
Right.
You have a depreciating mechanical asset. The money is gone. This is why wealth is what you don't see.
Wealth is what you don't see. It is the active restraint required to not buy the Ferrari. It is the capital that has not been converted into tangible, signaling objects. It is the unspent optionality sitting quietly in a brokerage account.
But this forces a philosophical question, doesn't it? If the purpose of wealth isn't to acquire signaling goods to impress strangers, what is the utilitarian function of holding capital? Why practice the restraint in the first place?
Because the highest dividend money pays is not a material object. The highest dividend is control over your time. It is the unprecedented freedom to wake up every single morning and definitively say, I have the agency to do whatever I want today, on my own terms.
We really have to contextualize this within the macroeconomic shift of the last 50 years. In a post-industrial, knowledge-based economy, the rules of competition have fundamentally changed.
Yeah, totally different game now.
50 years ago, if you were the smartest, most competent engineer or manager in your local geographic area, you possessed a durable competitive moat. Today, in a hyper-connected, remote work global economy, attempting to compete purely on baseline intelligence is a mathematically doomed strategy.
Because there's always someone smarter.
There are millions of highly educated, hyper-competent individuals across the globe willing to do the analytical work. Roughly 600 teenagers ace the SATs every single year. You simply cannot outsmart a globalized talent pool.
So if IQ and raw data processing are basically commoditized at this point, what is the differentiating asset?
Flexibility, the ability to dictate your own timeline. Having unspent savings, that invisible wealth, gives you a structural call option on your own life. It grants you the flexibility to reject a suboptimal job offer and wait for the precise right career opportunity.
Right, you don't have to just take the first thing that comes along.
Exactly. It buys you the runway to pause and acquire a new, high-leverage skill when artificial intelligence disrupts your industry. It provides the ultimate leverage, the power to simply walk away from a toxic work environment without facing financial ruin. The ability to execute decisions on your own timeline when the majority of the population is forced to act out of financial desperation is the most robust competitive advantage remaining. Control over your time is the ultimate currency.
Okay, I am going to aggressively play devil's advocate here.
Go for it.
Because conceptually, this all sounds flawless. Save your money, ignore the signaling goods, be patient, endure the drawdowns, don't panic during recessions. But let's look at reality for a second. Advising an investor to just behave better is phenomenally thin advice.
It is.
It's like telling someone with clinical depression to just cheer up. Human behavior, especially when intertwined with financial survival and evolutionary status seeking, is nearly impossible to permanently modify. We are biologically wired to panic when our resources are threatened.
You are identifying the exact friction point where academic finance fails completely. And the solution is not to demand that investors attempt to suppress their biology and act like coldly calculating algorithms.
So what's the solution?
The solution is to design a financial life that actively embraces the fact that you are a flawed, emotional, highly reactive human being.
Which means we have to stop treating the spreadsheet as a deity. We have to abandon the pursuit of being perfectly rational.
This is the critical distinction, the chasm between being mathematically rational and humanly reasonable.
Okay, explain that.
Let's use a biological analogy. If you contract a bacterial infection, your immune system triggers a fever to create a hostile thermal environment for the bacteria. From a purely biological and mathematical standpoint, it is entirely rational to want the fever to spike. It is the optimal strategy to eradicate the pathogen.
But experiencing a fever is physical agony. You are shivering, your joints are aching, you are completely incapacitated.
Exactly. So what is the standard human response? You go to a physician and demand an antipyretic medication to reduce the fever. It is technically irrational to lower the fever because you are prolonging the infection, but it is entirely reasonable to take the pill because the pain is intolerable.
Oh, that makes so much sense.
The goal isn't mathematical perfection. The goal is curing the disease within the confines of what the patient can psychologically and physically endure.
We don't actually want the mathematically optimal strategy if it makes us miserable. We want the strategy that allows us to sleep at night. And by the way, this isn't just an excuse for amateur investors either. Let's look at the absolute apex of academic finance. Harry Markowitz.
The Nobel laureate.
Markowitz literally won the Nobel Prize in economics for pioneering modern portfolio theory. He mathematically defined the efficient frontier, the exact mathematical formula for optimizing the covariance matrix to perfectly balance risk and return.
He is the foundational architect of rational finance.
Right. But when an interviewer asked Markowitz how he allocated his own personal retirement funds in the 1950s while he was actively developing these exact Nobel-winning models, he confessed that he completely ignored his own optimized mathematics.
He didn't use it.
He didn't plot his assets on the efficient frontier. He utilized a primitive heuristic. He just split his money 50-50 between stocks and bonds. And his explicit reasoning, he did it purely to, quote, minimize future regret.
Wow.
He knew that psychologically, he couldn't stomach the regret of missing out on a massive bull market, but he also couldn't tolerate the agony of losing everything in a crash. He purposefully selected a mathematically suboptimal allocation solely to protect his emotional equilibrium.
And that choice is flawless. It is deeply reasonable. To see the catastrophic danger of ignoring reasonableness, contrast Markowitz's approach with a famous paper published by researchers at Yale.
Oh, the leverage paper.
Yes. These academics published a mathematically perfect life cycle investing strategy, advising advising young professionals to utilize 2-to-1 margin debt to purchase equities.
200% leverage.
Right. The rational logic is that when you are in your 20s, your future human capital is huge, but your liquid capital is low. Therefore, you should maximize leverage because you have decades to recover from a potential drawdown.
But utilizing 200% leverage means a 50% market drop completely wipes you out to zero.
On a spreadsheet, calculating expected value over a 50-year timeline, it is technically the strategy that maximizes lifetime returns. But in the real physical world, it is insanely unreasonable.
Because nobody can survive that psychologically.
No human being with a pulse can watch their entire levered retirement account evaporate into negative equity during a 2008-style crash, experience the terrifying sequence of returns risk, and unemotionally stick to the leveraged plan. They would inevitably panic, capitulate, and sell at the absolute bottom and likely suffer a psychological breakdown.
Even Morgan Housel, the author synthesizing all these concepts, openly admits that his own personal financial architecture is mathematically irrational.
How so?
He writes about holding a disproportionately large percentage of his net worth in cash, yielding almost nothing, and choosing to completely pay off the mortgage on his house during an era when interest rates were historically low. Mathematically, the rational move is to keep the cheap 3% mortgage debt and invest that cash into an index fund to capture the spread.
Of course. That's Finance 101.
But he paid off the house anyway. Why? Because the absence of debt provides a psychological dividend. He sleeps perfectly soundly knowing that no matter what happens in the macroeconomy, no bank can ever foreclose on his family's shelter.
I want the listener to really sit in that realization. Being reasonable will always beat being rational. If a technically imperfect, emotionally comforting, slightly inefficient strategy allows you to stay in the market for 50 years without panic selling, it will mathematically crush a perfectly optimized, hyper-rational strategy that you abandon in terror during the first recession.
Because endurance is the only metric that matters.
Endurance is everything.
The psychological capacity to just stay on the ride. But that raises the final and perhaps most difficult structural question of this entire deep dive. If you successfully stay on the ride, if you allow compounding to operate, if you avoid the leverage traps and accumulate invisible wealth, when do you actually get off?
That is the ultimate test of behavioral finance. The entirety of this discussion, all the mechanics of compounding risk and reasonability, collapses into a single, extraordinarily elusive concept: knowing when you have enough.
Let's examine what happens when that concept is completely absent. Look at Raja Gupta and Bernie Madoff. We're talking about men who possessed wealth that most humans cannot even conceptualize. Hundreds of millions of dollars.
Empires of wealth.
Gupta was the CEO of McKinsey, sat on the board of Goldman Sachs. He had prestige, geopolitical influence, the respect of the global elite, and yet he engaged in blatant insider trading with Rajaram. Madoff ran the largest Ponzi scheme in history. They risked their freedom, their legacy, and their family's security. Why? Why risk federal prison when you already possess $100 million?
Because their internal goalposts never stopped moving. They were suffering from toxic, mimetic desire, constantly comparing themselves to the billionaire next door. They were playing a finite game with no defined finish line.
Which is just a recipe for disaster.
Warren Buffett summarized this pathology perfectly when discussing the catastrophic collapse of the hedge fund long-term capital management. He noted that to make money they didn't have and fundamentally didn't need, they risked what they did have and did need.
That is incredibly foolish.
It is an evolutionary glitch. If you risk something of profound importance to you, your freedom, your reputation, your baseline security, to acquire something that has zero marginal utility to your actual happiness, you have failed the most basic test of finance.
The only operational edge that never breaks in finance is the psychological ability to know when you have enough. And that circles right back to the core blade of this entire philosophy. Wealth is what you don't see. It is the ego that remains unstroked. It is the leveraged risk not taken out of sheer boredom or mimetic greed. It is the quiet internal confidence of knowing you have enough runway and you feel absolutely zero compulsion to prove your net worth to the driver in the Ferrari next to you.
When you close this app and look at your own financial architecture, stop obsessing over how to squeeze out the absolute highest marginal return. Stop hunting for the mathematically perfect optimization formula. Start asking how you can design a financial life that gives you total control over your time, a life robust enough to endure the inevitable macroeconomic terrors, and reasonable enough to let you sleep deeply at night. Because true wealth is what you don't see.
I'll leave you with this final thought to challenge your assumptions. If economic history is essentially just the study of unprecedented, surprising events, things that have never happened before suddenly happening all the time, ask yourself, is your portfolio built to survive a future that looks absolutely nothing like the past? Because if you're only preparing for the risks you can already imagine, you're not actually preparing at all.